You made $7 million last year.
Yeah.
How much money did you pay in taxes?
Last year I didn't pay any in taxes. I paid 0 federal taxes last year. The only check that I wrote last year was to the state of California in the amount of $26,000. And the reason why is because I was shifting enough income off of my tax returns to reduce my tax bill, and I invested enough into real estate to create enough paper losses that could offset my active forms of income. So it's a lot of things that I had to do in order to pay 0% in income taxes.
Welcome back to Tax Made Simple. I'm your host, Karlton Dennis, and in today's video, I'm going to show you guys a little bit about how I take tax write-offs as a tax professional. We have James from School of Hard Knocks in this episode, and I would love for you to watch back and see how we do it.
Got the G-Wagon out here, the Lamborghini truck. You got to go see what he has to say. Come on, you guys. Karlton, what's going on, man? How you doing?
Good to see you.
Great to see you.
Yeah.
Thank you for having us out here.
Welcome
man.
to Orange County, man.
Yeah, this is a beautiful spot you got. We saw the Lam truck and the G-Wagon out front.
Just a few write-offs.
Yeah, man. So the last time we saw you, our video did over 60 million views across social media.
Woo!
Yeah, and
Let's go.
people have to know. You got to give them some more game on seriously what it takes to be able to make millions of dollars and not have to pay crazy tax bills. Because a lot of people go broke having to pay taxes.
Absolutely.
And I'm sure you've seen that pretty often.
I see it all the time, man. Most people don't understand the tax game, so they just end up overpaying year after year. It's like giving Uncle Sam a tip. And I don't like that. So if you're somebody that wants to leverage the tax code, you got to start with education.
We're about to get all into it today. So let's kind of walk around the spot, head out here, and we'll dive deep on the tax code today.
Man, let's do it.
I have to ask you a question, though, because you specialize, you're a business consultant.
Yeah.
Tell me about what you do.
Yeah, so I run a tax strategy consulting firm. There's a lot of tax professionals that simply do tax preparation. My consulting firm does tax reduction strategies. So we're consulting with clients throughout the year to figure out strategies that they can utilize before they go into their CPA's office to file tax returns.
Yeah. So I guess what was the turning point for you specializing in taxes as opposed to any other aspect of a business, operations, scaling, strategy, but you're focusing on taxes? Why is that?
You know, I had no passion to actually focus on taxes. I was a fitness professional, but I didn't report all of my fitness income when I graduated college. So I got a letter in the mail from the IRS telling me I owed more money than I had in my bank account. My mother had owned a tax and accounting firm for the last 20 years. I called her up. She's like, Karlton, you should have had an LLC. I'm like, what does an LLC stand for? A year later, I joined her office, started a sales division inside of her company. 5 years later, I got my enrolled agent's license, and I knew that there was an absence of tax professionals that were teaching people how to reduce their taxes, but there was an abundance of tax professionals that were teaching people how to file a tax return. Most people don't want to learn how to file a tax return. They want to learn ways to reduce the amount of taxes and then let a CPA file the return for them.
Wow. I got to check out this backyard right here, man. It looks crazy out here.
Thank you.
So real quick, I have to ask though, because we're in Los Angeles right now.
Yeah.
This is one of the toughest states, I would say, to be in regards to paying taxes, right?
Yeah.
There's a lot of taxes you have to pay here. Why do you still reside here knowing all that you know about the tax code and everything like that? Why? Because what percentage does your bracket have to pay in taxes? Probably like 40 or 50%, something.
Yeah, if you're somebody that lives in California, you could pay upwards to 50% in taxes. I personally don't. One of the things that I utilize here in California is this rule called the AB 150 law, which essentially allows for you to pay your state taxes up front, and then you get to deduct them on the federal side of your return, and you get like a little rebate when it's time to file your state taxes. So it's a little way for you to recoup some of the amount of money that you would have paid in state taxes by getting a little bit of tax relief. But I get asked this all the time, Karlton, why do you live in California? Why don't you just live in a non-tax state jurisdiction? I mean, if you were to ask one of heaven's angels, would you want to leave heaven? I know that they would say no. And I believe California is like heaven. I've gone to almost every single state in the United States. I love Florida. I love Texas. I just like California more for my living. And I think that if I can offset 100% of my federal taxes, I'm okay with paying a little bit on the state side.
That's incredible. Like Southern California will always be a brand.
Yes, 100%.
Yeah, so,
it will.
Yeah, so let me ask you this again. We talked about in the last video, how much money did you make this year?
So last year we did a little bit over 7 million. This year we'll do a little bit over 11 million.
$11 million this year?
11 million this year.
What did you implement? How are you going from 7 to an $11 million company? Is it just more marketing? What is it that's taking you from 7 to $11 million, touching the 8-figure mark?
Yeah, so last year we doubled down on sales. This year we doubled down on marketing. And I can confidently say marketing is more important than sales, because if you don't market your services, you have nobody to sell to. Yeah. This was the first year that we decided to incorporate ads and paid marketing, and we saw a benefit from it.
A lot of people are extremely good at what they do, but no one knows what they do.
Yep, that's exactly right.
So let me ask you this again, right? You made $7 million last year.
Yep.
How much money did you pay in taxes?
Last year I didn't pay any in taxes.
You got to break that down.
No,
I
paid zero federal taxes last year. The only check that I wrote last year was to the state of California in the amount of $26,000. And the reason why is because I was shifting enough income off of my tax returns to reduce my tax bill, and I invested enough into real estate to create enough paper losses that could offset my active forms of income. So it's a lot of things that I had to do in order to pay 0% in income taxes.
And you not paying any taxes, or that you paid the $26,000, are there no legal issues involved with that, or how are you kind of avoiding those issues? Because some people would say, oh, that and on our video, people were commenting the IRS is going to be after you, but you mitigate all that risk because you're doing it the right and the legal way. Can you break that down, what that process looks like to be able to make that kind of money and not have to pay half of that, more than half of that in taxes to the government?
It's not patriotic to pay taxes. It's more patriotic to not pay taxes and to figure out ways to continue to not pay taxes, because the government created a tax book that is a legal playbook on how to avoid taxes. All that I do is I go into that playbook and I figure out what are all the strategies that coexist with Karlton Dennis, the person, and are these strategies that I can execute in a 365-day period. If I believe in the strategies and I invest in those strategies and do the things that the government wants me to do, like providing affordable housing, investing in oil and gas, providing solar energy to taxpayers, I'm going to get tax credits for it, which turn around and offsets my income and can also create passive income for me at the exact same time.
So what are some of the industries that you've invested in personally that's been able to allow you to alleviate that bill and not have to pay anything to offset that? In our prior interview, we talked about real estate.
Yes.
Is there a specific type of real estate that you should be looking to buy to be able to qualify for these exemptions from having to pay these crazy tax burdens? Or what are you investing in to be able to prevent these insane tax bills?
It depends on the type of income that you're earning. If you're a full-time W-2 or 1099 taxpayer, highly recommend that you look at short-term rentals, because the IRS will allow for you to manage the short-term rental for 100 hours and it becomes an active business. If your tenants are staying in the property 7 days or less, you can perform a strategy called the cost segregation study, which forces a paper loss on the tax returns, and that paper loss is what can offset somebody's W-2 or somebody's 1099 income. If you're somebody that maybe has a spouse that's not working, maybe it's like a husband that's working and the wife's home taking care of the kids, this is a perfect situation where you can make your wife a real estate professional. She manages over the real estate portfolio, and you can then make the real estate portfolio an active real estate business. If you perform the cost segregation study strategy, it creates a large tax deduction on the paper, and then that paper tax deduction can offset your W-2 or your 1099 income.
Wow. Now, I can speak for a lot of entrepreneurs. Like this year, our company will do, this is our first year that we're doing 7 figures.
Congratulations,
thank you, my friend. Hey, 22, not too bad for 22.
Not at all.
But I wanted to ask though, right? Because most people that get into business, they don't realize the insane amount that you are going to have to pay in taxes if you're not smart about having a strategy to kind of avoid that. So let's talk to the people that are just starting out. Maybe let's say that they're making their first 6 figures. They're making $100,000 this year.
Yes.
And maybe they didn't run super lean, where they had some expenses, they didn't have great margins, and they can't afford to in their business pay insane amounts in taxes. We see this a lot, especially for people that are just starting to kind of make a lot more money, 6 figures, 7 figures. What are some of those initial steps that people should take to, again, avoid having to pay these crazy burdens? And maybe if they don't have the means to be able to start investing in real estate, are there any other things that people can do to be able to avoid having to pay crazy tax bills to save a lot more of that money?
Yeah, the first thing that you want to do as a self-employed individual that's starting to come into some money is look at your entity structuring. Most self-employed individuals start out as sole proprietorships or single member LLCs, and that's great until you cross about $50,000 to $60,000. Once you're across that point, you need to look at switching to an S-corporation to avoid paying self-employment taxes. It's this nasty 15.3% on all of your business's profits. If you just switch to an S-corporation, you can give yourself a salary now, and now you only pay that 15.3% on whatever you took out of your business. You completely avoid 15.3% on the rest of your business's profits. So that's step number 1, entity structuring. Step number 2 is let's figure out, did you take advantage of all the things that you spent your money on? Because sometimes business owners spend money on things that they didn't know were write-offs. And so we can allocate expenses that we're taking on the personal card over to business if you forgot or didn't know that something was supposed to be a business write-off. This can include cell phones, laptops, travel that should have been business travel that you thought was personal. We can allocate those expenses over to your business to drop down that total liability.
Wow. And you brought up an S-Corp.
Yes.
Somebody's about to start their company. What is the best business people should start, whether it's LLC, S-Corp, C-Corp? Obviously, some of it depends on the revenue levels, how much money you're making, but what's the best business that people should look to start to be able to avoid having to pay insane amounts of taxes?
So the entity structure definitely is the LLC LLC first, and then as you grow your income, you want to look at switching over to a C corporation. But then we work with some businesses that are even getting to a point where they might want to exit their company in the next 5 or 10 years. That's when we look at transitioning to a C corporation. Depending on the type of income you're earning will determine the type of entity structure you set up. If you're a real estate investor and everything that you own is passive income, passive investments, we'll probably leave those LLCs as LLCs. But if you're an active business owner, like a consultant, doctor, physician, and you make over $50,000, $60,000, that self-employment tax starts to creep in, and that's when we want to start looking at an S corporation. So I would say the LLC and the S corp are absolutely the two most popular entity structures, and then when you start pushing into that higher income or you're about to exit a company is when we look to the C corporation.
What's the biggest difference you notice in people's approach to taxes from middle class versus wealthy people? How do wealthy people approach taxes as opposed to people who are stuck in the middle class?
Speed. When you're wealthy, you're asking me, Karlton, where do I move the money to? When do we set up the foundation? Where do I send the wire? It happens in hours, not days, not weeks. When I'm dealing with middle class, they're nervous, they're analysis paralysis. They want to do more research than the tax professional did. And it comes down to the fact that they're scared to spend money in order to save money. Wealthy people understand I have to spend money in order to continue to play this game that Uncle Sam wants me to play. And so they're willing to invest money into different vehicles quickly to avoid taxes, whereas the person that's in the middle class is more attached to the money and will take their time to determine if they're going to make an investment to offset their taxes, which could end up leading to them being in a situation where they just end up paying.
How long have you been running this business for?
9 years.
9 years.
Yes.
Over these 9 years, how much money have you saved your clients in taxes? If you had to estimate, give me a number, how much money have you saved your clients in taxes?
Well over $100 million.
Over $100 million. Do you have a specific scenario or example of a client that you worked with where they were coming to you stressing about how to pay crazy taxes? You don't have to say the person, but could you give me a scenario?
We had a scenario of a woman who came into the office. This was previous to the pandemic, where we used to meet with people face to face. And she had an IRS audit where she had taken a vehicle on her tax returns. She had already visited 7 other CPA firms. They said that they didn't want to work with her. When she came in, I looked at her tax returns and I saw the notice. They were disallowing a vehicle on her tax returns in the amount of $1 million. I asked her what the vehicle was. She told me it was a yacht. I said, why would we purchase a yacht for business? She said, I am a real estate agent. I speak on TV, $1 million listings, and I like to show my athletes and entertainers what it would look like to purchase a house from the views of the ocean. I log all of the time that I go on and off of the boat. I have a captain that knows every single person that's come on and off the boat, and I've documented everything. By taking her captain's log booklet, some of the photos that she had, as well as the expenses from her P&L, we went into the audit and leveraging code section 162A, which states that a business owner can take a business deduction if the business deduction is ordinary, necessary, and reasonable to the business owner in the pursuit of income, we should be able to take the write-off. We won that audit in less than an hour. And that was her ability to be able to write off a yacht. So when I have clients coming to me stressed out, sometimes it's stress around a $1 million yacht. Sometimes it's stress around a $50,000 tax bill, but it's up to me to figure out how to mitigate it.
Now, when I interviewed you out in Los Angeles the last time, you were in a Ferrari.
Yes.
And I know you got the G-Wagon, you've got the Lamborghini Urus. Are they here today?
Yeah, those are outside.
Could we go take a look at them real quick? Let's go take a look.
We got a few of the whips here right now. We might be picking up a new whip today, actually.
What are you going to be picking up?
So my Ferrari's in the shop right now, and they called me and they're like, hey, we have another Ferrari or we have this Lamborghini SV. Which one would you like more? And I was like, I don't know. I kind of have a Lamborghini, but I'll come down and test drive the SV. Yeah. And I went down and test drove the Lamborghini SV, and I think we might be picking the Lamborghini up.
Yeah. Now, what's crazy is most people look at cars like this as, they call it like the depreciating assets. How do you feel about that perspective that people give you whenever they say that about cars?
Cars are depreciating assets. I 100% agree with them, but I also took 100% bonus depreciation on this car, which saved me, I don't know, about $92,000 in taxes. That $92,000 got reinvested into a multifamily property in Texas that's paying me cash flow of about $1,400 a month. So if you're somebody that knows how to do math, you can buy a vehicle like this, offset your taxes, reinvest the tax savings into a cash flow producing asset, and not worry about the fact that this car is still losing value sitting here in the driveway, because it losing value offsetted my taxes.
Right. So the G-Wagon right here, why is it eligible for that deduction? Is it because of the size and the weight of it, or why is that? Because I have heard that before, where depending on the type of car that you have, Is that what it has to do with, or is it just because of the?
Yeah, so with this G-Wagon, the gross vehicle weight ratio is over 6,000 pounds. And if you have a vehicle where the gross vehicle weight ratio is over 6,000 pounds, plus the vehicle is being used more than 50% for business, the IRS will allow for you to take the vehicle's purchase price and write it off on your tax returns under Code Section 179 plus Code Section 168. So I utilized this strategy in 2022 on this vehicle right before bonus depreciation went to 80% in 2023. We're here in 2024, bonus depreciation is at 60%. Donald Trump just got elected president. There's a possibility that bonus depreciation could go back to 100%. And as a tax professional, I'm waiting to hear about that.
Wow. Now, a couple months ago, I actually interviewed a lady out in Beverly Hills, and she was coming out of a G-Wagon. I asked her, what she did or how much money she made. And she's, let's just say, at least 10 times what a G-Wagon is. And the reason why I'm asking you this is, and I want to talk about business here for a second. What does it take? This is a lot of people's dream car.
Yeah.
And you've got a lot of them. But let's just take the G-Wagon, for example, 100, 200,000, sometimes more than even that for this car. A lot of people dream to be able to afford a car like this.
Yeah.
How can somebody get a G-Wagon in today's world? Let's give them a piece of advice. We talked a lot about taxes.
Yeah.
Give them a little nugget about business on how somebody can look to kind of grow.
You can buy one of these cars if you understand leverage. As a business owner, I wasn't going to buy a car like this if I didn't get some type of benefit tax-wise, money coming back into my pocket. Here's an example. Let's just say that you're a business owner that's making $200,000 a year. You could put down a $20,000 down payment on a car like this and be able to write off the entire purchase price, which was about $200K. If you have $200K of income and you have a $200,000 write-off on your tax returns, you're essentially tax-free. Someone that has $200,000 of reportable income may pay $50,000 in taxes. So they're pocketing $50K and then put $20,000 down. They have a delta of about $30K. Now they can reinvest that $30K into cash flow producing assets or back into their business that can help them make more money. For somebody that's going to buy a car like this, I would highly recommend that you do so with leverage.
Yeah. There's a big debate in business. Good debt versus bad debt.
Yeah.
No, I love debt. Debt's bad. What's your thoughts on debt as a business owner?
Yes, there's good debt and there's bad debt. There's bad debt, which is consumer debt, credit card debt, high interest rate debt. That's the type of debt you want to avoid. And then there's good debt, which is debt in the form of loans, like buying a house. The reason why that is considered good debt is because you're parking your money into an asset that could appreciate over time, and you have the ability to borrow against the property. The reason why I love real estate is because I can take out cash out refinances or HELOCs, which means that even though I put my money into a property and I took out leverage, I may be able to pull out more than what I put into the property because of leverage. And that's why I love real estate. Many wealthy entrepreneurs have built their wealth by reinvesting into real estate over and over and over again. And God forbid something happens to them, their heirs pick up those properties, but sometimes they pick up those properties with no debt on the deal. And so when you think about it, the person that was living leveraged debt to build up this entire real estate portfolio and then passes it off to their heirs, sometimes without any debt on the deal. Yeah. So some of the wealthiest families got wealthy because of debt. And I'm always going to leverage debt to build my nest egg.
Yeah, I have a client out in Miami, owns several $100 million worth of real estate. And he actually said that you can tell how wealthy someone is based on the amount of access to debt and that they have,
yes.
Right? How much debt they're able to kind of pull out, which is fascinating. It's really interesting to think about.
The more debt I take on, the more I'm actually able to increase my buying power, because if I'm able to keep more of my hard-earned money in my pocket and not overextend myself while I'm leveraging debt, I can continue to increase my buying power because I'll be able to continue to take on more and more debt, but go into bigger and bigger investments because of it.
Right. So a lot of people, let's say, there's that risk. We see a lot of people get over leveraged though. They take way too much that they can handle,
yes.
Make bad investments with it. What would you say is the best way to go about taking a lot of capital? You said that the bank's your business partner at the end of the day. A lot of people don't look at them like that. What's the best way to go about make that partnership with the bank, take on a lot of capital and deploy that effectively to where you can make that money work for you and not worry about kind of the deal crumbling down upon you and end up owing, tens, hundreds, millions of dollars, or tens, hundreds of thousands of dollars, millions of dollars back to them?
Yeah, I think what it is that most people don't stop long enough to do debt to income ratio analysis, which is determining the amount of expenses that you have in a monthly basis relative to the amount of debt that you've taken on to make sure that the debt doesn't outweigh the amount of free cash flow that's coming in on a month-to-month basis. It's okay to have a lot of debt that doesn't cover or the cash flow that doesn't cover all the amount of debt that you have, but you should have substantial amount of cash flow to where you can go obtain more debt. What happens with people is they take on debt, they take on debt, they take on debt to the point where they've overextended themselves. If we go through a pandemic situation or an unforeseen circumstance, they may have to default on their loans. It could be multiple loans that they're defaulting on with large sizes. Banks don't like that. Ever since 2008, banks have very stringent underwriting processes now. And so they really try to prevent taxpayers and investors from getting into loans that they truly can't qualify for and can't afford.
Right. And in today's world, I would say it's a lot harder to get access to capital from banks. Do you agree with that, or does it just kind of depend on the circumstances? For example, like banks really have a hard time lending to restaurants because they're super unproven, right? What's the best way to kind of get access to that capital, that credit lines in today's world that you've seen has been efficient for yourself or other people as well?
The best way to get access to credit is to use credit and to start establishing the right type of relationships with bankers. I know that for me, it was getting into the banks and actually having a relationship with a banker. And then after having a certain amount of deposits, then you earn a private banker. Once you have a private banking relationship, you can pull a lot of strings. You get access to private equity deals. You don't have to go into the bank if you don't want to pull out money. If you need transfers, you don't have to pay for the transfers. You don't have to pay for the wires. And most importantly, they understand your business because they're a partner with you. So if you need access to debt, they understand what you're using the debt for because they have a pretty good understanding of what your business model is.
Yeah, I love that. Now, let me ask you this. We talked a lot about real estate so far.
Yeah.
Is there a specific type of real estate people should be looking to buy to kind of help offset the taxes, or just that you've seen is extremely profitable and like the cash flows? What's the best real estate people should be looking to buy right now in whatever market they're in?
I'm biased. I like multifamily real estate because I like real estate that provides the least amount of headaches, but the most amount of upside and security. When it comes to buying single family homes, you have one door, something happens, your tenant leaves, you're left stuck to pay the mortgage. I always think 2 to 4 units is a great place to start. It's manageable for the first or newbie to real estate investing, but more importantly, 2 to 4 units is that sweet spot where you're going to find tenants that just want to stay there for long periods of time. 2 to 4 units has tenants that stay on average 7 to 10 years. I like that. I don't want to have heavy turnover and have to constantly relist my property. And more importantly, when I'm going for properties that are 2 to 4 units, those are cash flow producing type of properties that people want to buy. So if they appreciate over time, great, I can borrow from the equity and do a cash out refinance or a HELOC, but also I can save taxes by doing a cost segregation study.
Yeah. And what city are you looking to buy property right now? Or does it matter? Does it just depend on the type of the asset class, or what's the best city people should be looking to invest in real estate?
Glad you asked that. So for me, I invest in real estate for 2 reasons. I invest in real estate for cash flow, a safe place to park my money, as well as tax savings. So when I'm investing in real estate, I'm not typically investing in real estate in places that have high land value. I'm investing in places that have high building value. What do I mean by that? Here in California, land is very expensive, but in Texas, land is very cheap. In Florida, land is very cheap. So when you buy real estate, the IRS only allows for you to write off the building. They don't let you write off the land. So you may spend $1 million in California, 500,000 of it's the land, 500,000 of it's the building. You only get the 500K. You take that same $1 million to Texas, 900K is the building, only $100,000 is the land. That 900K becomes your tax write-off. So I'm very conscientious of making sure I buy real estate, not only in states that are landlord friendly, but also have great building to land ratio so I can make sure I'm maximizing my tax savings. Wow. I'm looking in Texas and in Florida.
I love that. So that's where you own some property.
That's where I own most of my property.
Wow, I love that. That's game right there. Yeah. Seriously. What was the worst financial decision that you've made? I know you've made a lot of great financial decisions, saved a lot of money, made a lot of money, made that money work for you. What was the worst financial decision you've made?
I've made a lot of financial decisions that have turned into lessons. I wouldn't view it as financial mistakes. I guess one of the things that comes to my mind is trying to cut a corner.
Yeah.
As business owners, we get so tempted to cut corners because we just want to get to the destination. But being a business owner is truly about the journey. It's really honestly never about the destination. It's always going to be about the journey. But I try to cut a corner as a business owner by paying a company to help me get meta verified on my Instagram page. I had so many fake accounts popping up as me, Karlton Dennis, crypto, trying to hack and send people's money. And so it was before Meta had the ability for you to pay the $15 to have the Meta verified check mark on your Instagram page. So I paid some company like $25,000 to try to get me Meta verified. They weren't able to do it. It was like this whole 6-month long dragged out thing. And I just looked back at that and I was like, if I would have just waited and, just stuck to what I was doing, I probably would have gotten verified naturally anyways. But I was trying to cut a corner just to avoid clients getting scammed and also to create that credibility and establishment with social media. And I got burned a little bit. I never got that money back, right? So, I've had lessons that have cost me more than $25K, but that's the first one that comes to my mind.
Let's say someone's making $100,000 a year right now. Do you have any specific strategies they can implement, like kind of a walkthrough, a blueprint on what they can do to be able to avoid paying crazy money in taxes?
You want me to do a walkthrough right now?
Could we?
Let's break it down on the whiteboard.
Let's go.
Let's do it right now. Let's do it. All right, so we said 100K, right?
Yes.
And this could be 100K W-2, 1099.
Entrepreneur.
Okay, it's 100K. Now, let's just say that I want to use a rental property to offset my taxes. I'm going to have to come up with a down payment. But here's what I could do. Let's just say that this property is $500,000 and I had a separate $100,000 that I saved up. So I'm going to take out a $400,000 loan. I could buy this $100,000 property. I just need one property. And what I'm going to do is I'm going to list this property as a short-term rental. Here's the reason why. If I list this property as a short-term rental, and if this property has tenants that stay in the property 7 days or less, and I manage the property for 100 hours, I can perform a strategy on this property called the cost segregation study. Now, this property right here is worth 500K, but with a cost segregation study, I can accelerate depreciation. On average, when performing a cost segregation study, you can get 20% of the building's purchase price as a year one tax write-off. So with $500,000 property, 20% of that would equal $100,000. If I had $100,000 W-2 income and I had a $100,000 loss on my tax returns from depreciation, I'm tax-free. And this is how somebody can take a $500,000 property, convert it to a short-term rental, manage it, create a paper loss, and offset 100% of their W-2 or 1099 income. And this is just with an example of someone making 100K. Imagine if there's somebody that's making $1 million and we took this property to $1 million or to $2 million. This game becomes so fun. And that's why I need debt, right? Because in order to buy this property, I may not have 500K saved up, but I may have 100K saved up, and I'm going to take out leverage, OPM, to get that other 400K.
Other people's money all day. Yep. I've said it before, I'll say it again. They don't teach that in school, right?
Absolutely not, bro. This game of building wealth and buying real estate is not taught in school.
So what's one more lesson about business that you can give to them that will not be taught in any business school?
Hire slow, fire fast, man. If you're going to go into entrepreneurship, you are going to need a team. A lot of entrepreneurs try to do everything themselves and it doesn't work. Eventually you have to outsource. And as you start outsourcing, you start becoming comfortable. Yeah. But what I would say is, as you choose people, understand who is meant to ride with you on your team and who's not meant to ride with you on your team. Hire slow, choose the right people slowly, because Rome wasn't built overnight. Right. But if somebody is not a part of your crew and can't stand there on the front lines and fight with you, get them off of your team immediately. Yeah. Hire slow, fire fast.
And they can't be money motivated either. They got to be mercenary. They got to really want to go out there and work with you,
Oh, yeah. Sales guys can be money motivated, and that's completely fine. But at the end of the day, what is that money for, right? So you really want to understand what somebody's values are, not just get somebody on your team that's super motivated to make money.
I got to ask you for one more. What is a tax hack somebody watching this right now can take with them into their business, their personal income that they can apply? Give them one more tax hack right now that is not taught, that most people do not know.
Most people don't know what the Augusta Rule is. And it's funny how the Augusta Rule came to be. It was a golf tournament called the Masters Golf Tournament it's held every single year in Augusta, Georgia. The issue with Augusta, Georgia is there's not enough hotels out there. So homeowners had to open up their primary residences to travelers who are coming in to watch this golf tournament. People have been watching Tiger Woods play at the Masters tournament for years. The city of Augusta, Georgia enacted a code that said if you rent out your property for 14 days or less, you don't have to pay taxes on the rental income in the state of Georgia. It's funny because A year and a half later, it became a federal tax code, IRC 280A. Now, anybody, whether you're a business owner or not, can rent out your primary residence for 14 days, charge rent, and not pay taxes on the first 14 days of rental income. This has been a strategy we've utilized with business owners because if you have an S-Corp, the S-Corp is considered a separate person from who you are. So you as a business owner who owns the S-Corp can rent your primary residence to your S-Corporation for 14 days, charge rent and deduct it on your tax returns. And it's like a tax-free distribution coming right back to you, the individual. Definitely a strategy that most taxpayers are not implementing, but is so easy and is low-hanging fruit. And I absolutely recommend you get it implemented.
That's straight game right there.
Thank you for making it to the end of this video. I hope that you liked it. But as always, like, comment, subscribe. You know what it is. I look forward to seeing you in the next video. Out!